All right, folks, things are getting pretty interesting in the markets. So, the relief rally we saw after that brief pullback, it could be turning into something bigger. So, if you remember, I have been pointing out that 513 resistance level on SPY. And I had said that if you see SPY breach that resistance level at 513, that is the time where you could start entertaining bullish trades. Now, I do want to mention this that this is no more a relief rally, and what we saw on Thursday and Friday, markets are seriously moving up. In this video, I want to explore at what point can you go like hand over fist bullish versus conservative bullish. And of course, we always have the possibility that this is a relief rally and all hell breaks loose. So I'll explore all these three scenarios. This is the chart of SPY, by the way. And if you see all the levels that I pointed out, I was hoping for a proper 10% correction. Obviously, hasn't happened yet. I still haven't given up. Hasn't happened yet. And SPY has taken out that 513 resistance levels. But on Friday, let me show you a chart of DIA, Dow Jones. Dow Jones is leading the charge. You can see these massive green candles that we saw all of last week. Basically, 8 full days of bullish price momentum. Now, although Dow Jones did open higher, and in fact Nasdaq too on Friday, but we saw signs of stalling momentum, and markets, in fact QQQ briefly went red before it ended up slightly green. And let me zoom into this. On a 3-month daily chart, we are seeing a massive DOJI candle. If you believe in candlestick patterns, DOJI candle is one of those candles which show up at the end of a trend. So this could be a point where this trend actually changes again and we head downwards. But there is a big if for next week, and that if is the PPI data coming on Tuesday morning before market open and CPI coming on Wednesday. Since these markets are so inflation obsessed, these data points that come out, PCE, CPI, PPI, jobs, GDP, these data points hold a lot of meaning for the markets and are capable of changing market direction. So watch out for those 2 days. In fact, I didn't take any trades on Friday, and I'm not planning to take any trades on Monday either, because based on what PPI does to the markets, PPI is capable of reversing this entire move. So what PPI does on Tuesday, I'll maybe nibble on some trades, because then CPI is also coming on Wednesday. And finally, I'll start ramping up my trading volume after CPI comes out. Now, before I show some technical analysis charts here, let me also pull up QQQ. We are seeing a doji candle on QQQ. We are seeing a doji candle on SPY, which is maybe not as pronounced as what we saw on DIA. But the same kind of candles are appearing on all three indices. Now, having said that, let me switch back to my 9-month chart so we can see more on this on the screen. Now, since we are at this point where all-time highs are just around the corner, my belief is that a good PPI and CPI data is what is required for these markets to break out again to all-time highs. Without PPI and CPI supporting this brief rally, we are not going anywhere. So we are still in May, although today is May 11th at the time of recording this, and we haven't seen a sell in May happen yet. But remember, this is a traditionally weak month. Any bad inflation data coming out next week will be enough for this rally to be over. So if you look at a 9-month chart, let's start projecting some future moves. So if you look at a 9-month chart, I will start from this point on January 1st. And I will use a tool called Fibonacci extensions which I've used in the past for making future price projections. And it's particularly helpful when you are looking at a something called a blue sky rally. And these rallies happen when there is markets making new highs and there is no overhead resistance. So it's very hard to figure out at what point, how high can the markets go and what point can they pull back. So Fibonacci extensions is a really useful tool for that. And so if you are on TOS, Think or Swim, you can just go to drawings, drawing tools, and you will find Fibonacci retracements here and Fibonacci extensions right next to it. So let me choose that, and it's very easy to draw this. So all you do is go to the beginning of the current move, which is around here. You start drawing a line to the high of the current move, and then you stop at the low of the pullback, which is right here, which happened on April 19th. So if I stop there, it will put out these Fibonacci extension levels for you. So if you look at, so for a moment, forget about the Fibonacci extension. Let's look at the 513 resistance, which I've been talking about. So we are already past that. 513 resistance is already behind us. And as I had mentioned in my previous outlooks, this could be that level where you could start entertaining bullish trades. So it's perfectly fine if you grab some bullish trades, but we are not at that point where you go hand over fist bullish. So you need to be careful about that, because when you're looking at new all-time highs, you always have the possibility of a double top forming. So a previous high serves as resistance and the markets form a double top and market just go down. If we do see that pattern forming, I will make a video for that next week and explain to you how the double top happens, and if a double top does play out, what is the downside price target. And these patterns, I love these double tops and even double bottom patterns, because surprisingly, like when I started trading, I wasn't a big believer in chart patterns. And even now, like I don't obsess over chart patterns, but some of these patterns play out really nicely. So you could have taken some bullish trades after that 513 resistance was taken out. The next thing you need to watch out for is that 50% retracement level on the Fibonacci extension, which is right here, which also actually coincides with a previous all-time high of 524. So this is a very critical level. Now the thing is, it's very easy to know what's going to happen, because PPI and CPI will tell us what's going to happen. So if there's a bad CPI, bad high inflation data coming out next week, this rally just cannot go on and we'll start going down from here. And that is the time when a double top pattern will start forming. So watch out for that level. If CPI and PPI for some magical reason show slowing inflation, if you remember, we have been stuck at the current inflation level for months now. And so markets are just desperately waiting for some signs of inflation slowing down. And if we do get that number, 50% retracement level and previous all-time highs will be taken out with no problem. And I would imagine that the next upside target would be at 100% Fibonacci extension. And on this screen, you're not seeing the 100%. Let me make a quick change here. So I added some room to my chart, and now you can see 100% Fibonacci extension level is around 551. I know that looks really high right now, but a good PPI and CPI report is capable of sending us to those all-time highs. So what I'm trying to say is, yes, you could have gone bullish at 513, start nibbling on some bull call spreads or whatever your bullish trade structure is. But if you really want to ramp up your trading volume, you want to take a lot of bullish trades and benefit from a possible upcoming rally, then wait for that area of confluence to be taken out. So 523, we are already there actually, 520, almost there, 523. So once SPY takes out 523, and this will only happen if PPI and CPI show slowing inflation, then the markets will go into a massive rally. That's what my gut feeling is. We might be seeing like 2% up days in the following 2 weeks, and that is what will lead SPY to 550. And that could be the time where you just grab bull call spreads as your main trade structure to participate in that rally. Okay, now quick look at the major macroeconomic data coming out next week. So as I've been mentioning, Tuesday morning we get PPI. And if you remember, PPI is Producer Price Index, which shows you how the inflation that companies who are making products, the producers, are paying. So if they are seeing inflation, if they're paying high prices, they will always pass it on to the consumer, which then reflects in CPI. So it's down the pipeline. So so Tuesday we are seeing PPI, and then Wednesday we'll see CPI. These are the only two things that are important next week, and they are really important things because just these two data points will decide the next move in the markets. Okay, next thing, let's quickly go through these RRG charts, which show you where money is flowing. So when you look at the RRG charts, let me move this slightly so we can see better. So if you notice, it must be very obvious to you that Dow Jones is leading this rally. So Dow Jones has been constantly going up. I would say Nasdaq is showing some weakness, and mainly due to Apple and Tesla, because they are not participating in this relief rally or whatever you want to call it. Nasdaq is showing weakness, so anytime Nasdaq tries to go up, it gets sold off. But Dow Jones is definitely going up, and you can see that in this RRG chart. So XLK shown here is in the lagging quadrant, which is showing you that money is flowing out of tech. Where is money going in? Energy, XLE. XLB, materials, industrials, financials. All these, what market component are these a part of? That's Dow Jones. These are all in the leading quadrant. And in addition, utilities and staples, which are also part of Dow Jones, are also moving towards the leading quadrant. So that's why you are seeing all this momentum happening in Dow Jones, whereas tech is not showing as much strength. I had mentioned on Discord on Friday that Dow Jones is leading the charge. It's very obvious, but XLY, which is consumer discretionary, and XLK, which is tech, these two sectors mainly represent the risk on sentiment in the markets. Both these sectors are in lagging quadrant. So that's a very interesting, I would say, a kind of like a divergence indicator that although we are seeing a rally, growth and risk sectors of the markets are not participating in this rally. So something to watch out for. And obviously with PPI and CPI coming out next week, we don't know what's going to happen. But for markets to make new highs, usually growth and risky sectors like consumer discretionary and tech need to participate in that. So let's see what happens. The good news is we don't have to do any guesswork next week. Literally by Wednesday, all the data in front of us, and we'll know where the markets are going.